Good evening, Mr. Amir. In this video, we are going to talk about derivatives. Basically, a derivative is a contract between two or more parties whose value is based on the underlying financial assets. So derivatives are considered as risk management tool that allows investor to transfer the risk attached with the underlying asset to the parties who are willing to take it. So commonly used derivatives includes future contracts, forward contracts, options, swaps, and warrants. So there are actually two classes of derivative products. The first class is lock products, which binds the respective parties to the terms over the life of the contract. And the second class is the option products, which offers the right to the trader to become a party of the contract under the initially agreed terms. So this will be explained further in the video later. So derivatives can also be used to either mitigate risk, or we can say assume risk. So for example, a trader wanted to profit from an anticipated drop in an index price by selling the related future contract. So derivatives in this case is used as a hedge to allow the risk associated to be transferred between the parties that are involved in this contract. So moreover, the derivative market is also expected to reflect future demand. So this might influence production and storage decision and eventually reducing spot price volatility. So in other words, the derivative market is actually building a link between risk and economic growth. So in a nutshell, having advanced financial tools foster a better distribution of resources that leads to more productive activities and at last enhancing the economic growth.
The establishment of the first derivative exchange in the 70s and the 80s, and also the appearance of product innovations, gave asset managers and market participants a large access to a broad range of new financial instruments, which enabled development of new trading strategies. So the question being, can derivative market play an important role on the economic development of a country? So based on the rate of physical capital accumulation and the rate of improvement in the efficiency with which economies allocate physical capital, we are rather certain that derivatives are able to influence financial markets and the economic development. However, due to lack of evidence, there is a debate over whether the derivative markets can really influence economic development. Derivative markets exercise their influence on capital markets and the economic development, which facilitates and increases accumulation of capital. Derivative markets have been successful in pooling enormous amounts of capital in the last few years, and the build-up of any needed risk-return profiles, which has drawn attention of various investors to build up exposure in the derivative market. Modern instruments of derivative markets for transferring resources across time and space, managing risk, and pricing information has improved the efficiency with which economies combine capital and labor in production, which has further grown to solidify the role of derivatives in the economies of all countries. So now let's consider the world's largest economies with large derivative markets. First off, the US, which has the world's largest economy with a real GDP of $19 trillion, followed off by China, which has experienced a remarkable growth in its GDP, now valued at $12 trillion, which makes it the world's second largest economy. So there are two important components of derivative markets, which are futures and options, which are widely traded around the world. Economic growth in China tended to be positively influenced by the derivative markets in its first year, but this effect kind of became negative later on. However, it has been rather moderate in the US. So we can kind of observe that different changes in derivative markets have a different impact on different countries. based on their currency, nature of income, and other GDP factors.
My name is Wei Han, and I'll be presenting about the future and options markets. Future and options are both financial products used by investors to make money or to hedge current investments. Future markets are a contract to buy specific quantities of a commodity or financial instrument at a specified price with a delivery date set for a specified time in the future. Future contracts have been in Malaysia since 1980s and were introduced to improve the marketing efficiency of palm oil at a time when KLCE was organized to find a hedging mechanism within the region. Palm oil became the first Malaysian future contract traded on KLCE, followed by rubber futures and tin futures. A series of crises resulted in the collapse of palm oil future contracts, and after the crisis, the government changed the direction of the country's economic policy, and this resulted in a loss of interest from commodity investors. In 1995, Malaysia had introduced KLSECI stock index futures contracts on what was then Kuala Lumpur Options and Financial Futures Exchange (KLOFFE). Due to a lack of coordination between financial futures and commodity futures, Malaysian Derivative Exchange (MDEX) was soon used, where KLOFFE and KLCE were merged together.
Okay, so now I'm going to talk about financial derivatives as a device used by organizations to control the risk. So why is it used? Because, for example, banks use derivatives to reduce risk exposure and to improve profitability. How does it work? So as long as investors take positions in derivatives towards opposite direction of the price fluctuation in underlying assets, uncertainty of future cash flow will be removed or will be hedged. Other than that, investors in derivatives markets, they also abide to a few strategies to reduce risk imposed if you're in the derivatives market. So firstly, we should also focus on 1 or 2 trading options at once for convenience of control. So if you're new, and you should probably consider trading in index options, as it moves slowly compared to other individual stocks, plus they're often less expensive. Next, we should also use less money. No matter how much is in your trading account, you should not trade more than 2.5k USD. So which is also allows to buy between 1 to 5 option contracts, which also equals to buying 100 to 500 shares of stock. It is often a big mistake by many people when they put in too much money on their first time out, which made them lose a lot of money in the process. So that's all from me.
In conclusion, the development of the derivatives market has played an increasingly important role in the financial market, serving not only as an effective hedging instrument but also as a useful provider of immediate information, thus boosting the efficiency of financial market operations. Recent interest focuses on how the development of derivatives markets influences the economy. Some research has theoretically suggested that the derivatives market positively affects economic growth by accelerating capital accumulation, making investment more efficient by offering more diversity in highly risky projects, and reducing the uncertainty in the economy as a risk hedging tool. However, insufficient empirical studies have been conducted on this important relation. We studied the relationship between economic growth, volatility, and the derivatives market, as well as other macroeconomic variables, which are trade openness and the interest rate. We selected the 4 major economies, China, India, Japan, and the US, which have a mature derivatives market for our analysis, using time series econometric methods on an updated dataset up to the last quarter of 2017. We concluded that development of the derivatives market had a positive effect on economic growth in the short run, as indicated in India, Japan, and the US, though it may gradually turn negative as in China. However, it was found to generate an unexpected effect on growth volatility in India. In light of these findings, this research supports the theory on the favorable effect of the derivatives market on economic growth. As such, we suggest that any strategy for enhancing the size of the derivatives market should be encouraged, especially in emerging and developing countries, so as to boost economic development. Although it is important to have a proper regulatory framework to prevent unintended consequences, such as creating a bad impression.